Our GDP is expected to materially decline. Let's have a look. Hello everyone, Florian Heiser here and welcome to another episode of Heiser Says. Grab your stein of coffee. We're going to have a talk about the latest statement from the Reserve Bank. Now they've made their monetary policy decision and surprising no one, they've kept the cash rate at 0.1%. Now, let's have a look at this statement because there's a few interesting things I think we should be aware of. Now, before we go into this, because, well, they're going to make some statements about GDP, I'm just going to bring up a definition, everyone, of what GDP actually is, because we talk about it a fair bit. And the media loves it. They love looking at this number because it's a one single number that you can use to say if you're doing right as a politician or right as a country. So, gross domestic product, the total value of goods and goods produced and services provided in a country during 1 year. So that's the definition of GDP. Now, it is not the most useful economic term or measurement, but politically, it's probably pretty useful there. So let's have a look at this statement from the Reserve Bank. So, at its meeting today, the board decided to maintain the cash rate target at 10 basis points and the interest rate on exchange settlement balances at 0%, maintain the target of 10 basis points for the April 2024 Australian government bond, continue to purchase government securities at a rate of $4 billion a week until at least mid-February 2022. Oh, isn't that fortunate that the RBA are doing that during this, challenging time? The Delta outbreak has interrupted the recovery of the Australian economy, and GDP is expected to have declined materially in the September quarter. Now, I'll bring up this chart right here. This is showing you our GDP growth, and you can see the recession there. See those two little quarters that it's gone down. That's the definition of a recession, everyone. You know what? We'll bring up this definition here, and let me just change from GDP over to recession. And, well, for recession, a period of temporary economic decline during which trade and industry activity are reduced, generally identified by a fall in GDP for 2 successive quarters. So that's what it is, 2 quarters going down. We may have a decline. It may even go negative. But we need 2 of them to have a recession. So, and I mean, remember, GDP, this is the entire country. So you could have certain industries, certain sectors that are in recession. So this is why it's not uniform, why we've got a K-shaped recovery, why all the people in retail. I saw footage in Melbourne, all these empty shops for lease. That sector's in recession, while others may not be. That's why it's not that useful a measure. So the outbreak is affecting many parts of the economy, but the impact is uneven, with some areas facing very difficult conditions while others are continuing to grow strongly. This setback to the economic expansion in Australia is expected to be only temporary. As vaccination rates increase further and restrictions are eased, the economy is expected to bounce back. Many businesses are now planning for the easing of restrictions, and confidence has held up reasonably well. There is, however, uncertainty about the timing and pace of the bounce back, and it is likely to be slower than earlier this year. People are probably going to be a bit wary. But I think they're right. There will be a bounce back. There'll just be pent-up energy that people will want to get out there and probably go a bit crazy. Much will depend on the nature and timing of the easing of restrictions on activity. In our central scenario, the economy will be growing again in the December quarter and is expected to be back around its pre-Delta path in the second half of next year. That's a bit of a wait. But then again, I mean, this is the central scenario. They've got high, central, low scenario. The restrictions on activity have had a significant effect on the labour market. Hours worked, the best indicator of labour market conditions at the moment, declined by nearly 4% in August. Looking forward, the bank's business liaison and data on job vacancies suggests that many firms are seeking to hire workers ahead of the expected reopening in October and November. Wage and price pressures remain subdued in Australia. In underlying terms, inflation is running at around 1.75%, and wages as measured by the wage price index are increasing at just 1.7%. While disruptions to global supply chains are affecting the price of some goods, the impact of this on the overall rate of inflation remains limited. House prices are continuing to rise, although turnover in some markets has declined following the virus outbreak. Housing credit growth has picked up due to stronger demand for credit by both owner-occupiers and investors. The Council of Financial Regulators has been discussing the medium-term risks to macroeconomic stability of rapid credit growth at a time of historically low interest rates. In this environment, it is important that lending standards are maintained and that loan serviceability buffers are appropriate. And we've seen data has been reported from the RBA that you've got people made a lot of prepayments, everyone. You've got liquidity buffers. People have got pools of cash just in case. Now, I'm of the opinion that these just have to last long enough for the government to intervene. Maybe I'm just becoming cynical now and I've been reading too much of all of this stuff. But come on. Can you blame me? So the bank's package of policies, including record low interest rates, the bond purchase program, the yield target, and funding provided under the Term Funding Facility, is providing substantial and ongoing support to the Australian economy. Yes, that's true, but what's the price to pay for this? No intervention is without consequences. Look at the US, look at what happened when they tried to taper. We'll see if they manage to pull it off. Borrowing rates are at record lows. Sovereign bond yields are at very low levels, and the exchange rate has depreciated over recent months. The fiscal response by the Australian government and the state and territory governments have also been providing welcome assistance in supporting households and business balance sheets. The board is committed to maintaining highly supportive monetary conditions to achieve a return to full employment. Now, you've got to remember, full employment is not full employment. There's going to always be a buffer. And we're going to have that because there's labour market interventions, frankly, anyway. So, and inflation is consistent with the targets. It will not increase the cash rate until inflation is sustainably within 2 to 3% target range. The central scenario for the economy is that this condition will not be met before 2024. Meeting this condition will require the labour market to be tight enough to generate wages growth that is materially higher than it currently is. So this is why when people are worried about interest rates rising and hitting property, are we going to see the wage growth to drive that? So there may be external factors that will drag the cash rate up here in Australia. So let's have a bit of a talk about this one, everyone. So I can't imagine any of you are at all surprised that the RBA has left pretty much everything the same. I wonder how long we're going to see this. I haven't even bothered updating my interest rate chart for several months now on my slide deck because they don't make any changes. Maybe it's a game to see how long I can keep that chart going. Now, if they keep the interest rate at this level, there's going to be a push for other measures to try and, curtail the housing market, the runaway price growth. Do you think their central scenario is correct? Hopefully it is. Hopefully we'll start to see a recovery. I think we certainly will see a bounce back in activity, and hopefully it'll flow through to other parts of the economy. But it all depends on the, honestly, we're going to be watching New South Wales. The New South Wales removal of lockdown restrictions and opening up, that's going to be the one to watch. Because then the other states, how are their premiers going to be able to justify their interventions if New South Wales is able to open and return to a sense of normal economic activity? We'll have to wait and see. As always, thank you all for watching, guys. Please like, share, and subscribe to the channel. If you enjoy the content I find and put together here, there's a few ways you can help out. Simply watching, liking, and commenting really helps. You can support the channel financially by joining us on YouTube or Patreon, signing up for Self-Wealth or Stake, using our affiliate links at Amazon, eBay, Independent Reserve, or Aussie Broadband. You can buy our merch from Heiser Says use Gold Pass from the Perth Mint, or support us via PayPal. Take care. I'll see you all next time. Bye for now.